short the S&P. And if we were going to go long the NASDAQ, short the Dow Jones and short the S&P, it starts to give you guys a bit of a heads up about what's going to be happening next. And that's when I shouted, we're going to be buying the NASDAQ soon. And that's why we gave you the warning, because I was aware that a few of you guys were in a short NASDAQ position. And as a result, our buying was going to be coming in against you guys, which obviously we don't particularly want to get too involved in. We would rather we were in the same trade, roughly about the same kind of point, and it just allowed you to make a bit of a decision about the exit process of perhaps your short trades that you had earlier. And sure enough, if you'd came in at the same times as we did, you'd have been able to recognize, of course, that the trade started to make some pretty good gains off those very, very obvious low prints, and we started to see some pretty good upside from the 14,320s up to the 14,370s, and you guys were able to make a good decision about your NASDAQ at that point, and perhaps get away from that short position that you were in. So it worked out nice. I hope you think so. It was a good one. Oil's been backwards and forwards. Pretty crazy volatility in oil, wasn't it? Nuts, in fact. Totally bizarrely nuts. Volatility crept into the oil there. And we started to see some pretty aggressive little spikes around that. Some comments coming out about, for example, Nord Stream. With some talks planned and stuff like that, various bits and pieces. The bond continued on its merry way on that parallel steepener. And the parallel steepener from 192, guys, 191.08s. 191.08s. Pretty impressive. I should say so, because we called this as a continuation bond trade. We called this as a continuation bond trade this afternoon. Not a reversal trade, a continuation short. And that is what a parallel steepener looks like on an outright bond position. And that's what you've got to try and remember, guys. We called this for you in advance of this happening, because we were buying the 2s, 10s. That's what we were talking about. And when you look at the bond price and you start looking at it from the perspective of this afternoon's open, you can see crystal clear that that is what the deal is. Into the bottom edge here, you can see quite clearly that at nearly 2 o'clock, the trade becomes obvious that it's moving into what should be a parallel steepening phase. And obviously, if it goes into a parallel steepening phase, you're going to make a lot of money by just holding on to your short position. It started around about 1330, but that's the data coming out. And then it developed further at 1350. And at 1350, of course, that's when we were getting into this little balance area phase here. So when you get into that balance area phase there, we gave you a shout specially to get into that for a parallel flattener. For a parallel steepener, sorry, for a drop in bond prices, which you can see has been exactly as I described it would be. A difficult market to fade, a market that you shouldn't attempt to fade, a market that is simply going to be selling on pullbacks, and a market that's made us an absolute fortune. Absolute fortune, guys. One trade, called in advance, and deliciously executed. I said that there was little we could do much on gold. I don't think that's changed particularly. There was a bottom edge swing that may have encouraged you in for a bit of business down here. You can see that we came into that demand area here, so you may have decided to take a flyer into some long gold into this trade here. That might have been a bit of business that you took on. Back up to the top edge at that stage, there was a bit of value, but it's not particularly clever. I think overall I still would be happy to pass on that as a sell trade, unfortunately, because it did make some money. But you can see into this area here, I just don't like either side of the book. I don't like either side of the book now, guys. I think gold looks as if it's finished out for the day. Yeah? Gold looks as if it's run its course. The specs have fortunately managed to find some confidence to come back into the markets, and that's why we've seen some nice bids coming back in on the we've seen some nice reasonable bids coming back into the market here on the Nasdaq and on the S&P. You can see the specs, which were bearish at the open, have managed to stabilize. You can see a very reasonable buy side addition just in here, and that's obviously led to the buyers being able to come back in at these low prints. You can see the buyers are coming back in at these low prints, and they've pushed the price back up quite comfortably on the back of that change. Now, obviously, one of the things that we talked about was the difference between the things like the Nasdaq and the S&P, for example, and that's something we just pay attention to if we're watching these. I don't have the Nasdaq on this chart, so we'll just put the Nasdaq on. So one of the things you'll probably be able to recognize with the Nasdaq is it was doing almost exactly the opposite to what the S&P was. It was brilliant for a spread trade, or an outright, in fact. That shouldn't be happening, should it? That should not be happening. Look at that Nasdaq, guys, and how crazy good that Nasdaq trade was setting up at the bottom edge here. It wasn't so much that the Nasdaq was doing anything different during this phase, because it's just about relative value at that point, isn't it? In terms of that point there, the S&P's dropping, the Nasdaq's dropping. Nasdaq's dropping a lot more than the S&P, but the Nasdaq may be leading the way, right? The Nasdaq might be leading. But that means that you haven't had any information from the specialists. You haven't had any information from the volatility dudes. If the Nasdaq's leading, one would imagine that the volatility traders are quite aware of the fact that the Nasdaq is the leader and are taking that into their considerations when they're pricing up the volatility spreads. Well, if that's the case, they've made a hash of it completely, because they didn't price up that storyline, did they? They did not price up that storyline one little bit. They were actually doing the exact opposite. They were agreeing with the S&P. So when we're looking at that Nasdaq and we start arguing that it's the leader, that can't be. You can't agree with that. You can't say that that's the truth. So the only conclusion you can reach at that stage is to say, well, you know what? The Nasdaq isn't the leader, but it might at this stage be the leader here, because the S&P is dropping hard and fast, and there is a little drop here on the specialists as well. However, when we come across to the side here, we can start looking at the side here and saying, well, you know what? The specialists are bullish. The Nasdaq's bullish. The Nasdaq's made a new test low. The game is over. Miguel is absolutely spot on. The reason why the Nasdaq is declining, of course, in relation to the S&P is because of the steepening 2s-10s curve. The steepening 2s-10s curve in a higher yield environment is going to have a detrimental impact on the interest rate sensitive sectors of the market, isn't it? So Miguel's a spot on, isn't he? Miguel's 100% spot on. And I appreciate Miguel, because one of the things that Miguel does is he challenges and he asks a lot of questions in the Twitter, and he asks a lot of questions in the room. And we've got somebody in Miguel that is trying desperately to really wrap his head around these concepts, and that shows a desire to crack it. Whether Miguel's cracked it or not doesn't make any difference at this stage. The more desire you've got to get this nailed, the better the chance you've got of nailing it. The better the chance you've got of getting to the bottom of this. If you can start understanding these relationships, as Miguel is trying to, and indeed succeeding in succeeding in understanding these relationships, what does it do for Miguel if he decided to trade the Nasdaq? What does he do? What Miguel does is he starts looking at that Nasdaq as a buying opportunity in due course, and says, well, I can understand and explain why the Nasdaq's discounted here. I can explain why Nasdaq's cheap here. I'm going to take a chance on this. I'm going to take a punt on this. Now, Obviously, one of the things you could do is you could buy the NASDAQ and sell the S&P as perhaps a spread trade. So that if you're wrong about the NASDAQ being the laggard, you can still make money on the back of the fact that the curve is expected maybe to start flattening out a little bit because it's already steepened or whatever reason. So obviously what does happen, of course, is that the NASDAQ makes a good attempt. It fails on the first move, comes back down, and you say, okay, well, I'm getting an even bigger discount, so we're going to try it again. We're getting an even bigger discount. I'm going to try it again. And you buy into the NASDAQ a second time. And again, you may take it as a spread trade. You may take it simply as an outright NASDAQ. And obviously, you get a very, very nice lift in the NASDAQ. And when the specialist starts selling off here, you can, instead of closing the NASDAQ position, you could actually maybe try and maybe sell some S&P against it. And what happens is the NASDAQ continues to gain, the S&P goes sideways for a while, and that turned out to be a brilliant trade, because if you look at where your S&P is now, the S&P is actually in profit now at this stage. Your NASDAQ is in massively in profit, and you've got some risk hedging against that overall position, haven't you? If you're long the NASDAQ and you're short the S&P, of course, what you're thinking about is that perhaps the curve has steepened enough. And you would actually benefit significantly from a flattening curve environment to take advantage of your short S&P position at the expense perhaps of a more lagging nature of the NASDAQ, because the NASDAQ should now move towards a slightly more bullish position against the S&P if the curve does indeed start to flatten. That logical process becomes the way you start understanding the market movement. The transition that Miguel may well have seen from the early stages of his understanding of the markets, and Miguel's been in this classroom for a while now. It's taken a while perhaps to get to a point where you're starting to see the market as a professional sees the market. When you start understanding the way a professional sees the market and you start narrating in it, and this is why I'm thankful to Miguel for doing that, because Miguel does narrate the reasons why. He does try and answer questions, rightly or wrongly. Every time there's a question, he tries and sees whether he's right. He puts himself on the line to see whether he's correct in his answering. And that allows Miguel to develop an idea, a thought. The next stage, of course, is monetizing that process and saying, I can make money out of this now. I fully understand it. Mary made mention of the other day about doing a trade that she didn't understand. What a great, honest admission from somebody, right? Because the trade lost money. The trade lost money. Mary looks at it and says, what the hell was I doing a trade here for? And I didn't understand what I was doing. I didn't fully appreciate the various things that were going to affect my trade. What a revelation for a trader to make. Because the next time that happens, you're not going to make that stupid mistake again, are you? Everybody makes stupid mistakes. But if you don't know they're stupid mistakes, how can you ever fix them? That's the problem for the vast majority of the retail public, is they consistently make stupid mistakes, but they don't know why. So they're bound to just keep repeating them. Yeah, I sold the overbought stochastic and it never worked, and I don't know why, so I've changed the stochastic from a 25 to a 15 and see if that improves. Well, of course, that's going to definitely improve their probability, isn't it? Not. The point is that you start to know why you're not making money. 99% of retail traders can't tell you why they're not making money. They can have wild guesses, but they can't really tell you why they're not making money, because they're just making it up. They're making it up. They're not understanding what drives the markets. This understanding, this process, is vital. The colouring in of your narratives I go on and on and on and on about. You guys aren't in the luxury position of being able to be a floor trader. You're not in the luxury position of being a desk trader and being told by your bosses to do a trade. You've got to buy it. I don't care what you think. I want you to buy it. You've got to buy it, and that's how you get paid. You guys have got to be analysts, floor traders, desk traders, economists. You guys have got to be everything to yourself. Money management, risk management. You've got to be good at all of those things before you can become a successful process going forward. And that's what you've got to try and realize, that there's going to be aspects of your trading that are better than other aspects. Some of you are going to be great analysts. Some of you are going to be great traders. Some of you are going to be average at both. Some of you are going to be great at both. The point is that you've got to try and figure out which ones you are good at and which ones you need to work on, and work on them. If you're terrible trading, you've got to fix it. If somebody keeps looking at that and saying, I know exactly what I'm going to do, I'm going to sell the top edge, and then 10 minutes later the top edge has been and gone and you still don't have a sell, your analyst seems to be good, but your trading seems to be absolute pants. You're going to have to fix that. And just because you know what the driver is, Mary, doesn't mean you're going to always make successful trades, because trading is about probabilities. It's never going to be about certainties. But the point is, at least you're now in the right game of making the right probability distribution. You've still got to make sure you find the best trade inside that probability. So when I'm looking at this trade here, you might say, well, when did this become a buy trade on the NASDAQ? You know, when could I have bought this? Because it could have been potentially a buy trade here, could have been a buy trade here, it could have been a buy trade here. Why was this the buy trade? And obviously hindsight is because it was the lowest price. But you don't know that in hindsight. So you've got to find a way in that area. You've got to find a way in that area to find that buy trade. You've got to have a process. We talked somewhat about that process this morning when we were looking at the MZ pack, and we'll talk a little bit more about that in classroom this afternoon when we get started. But I thought we would just touch on some of these elements. It's all about probability, guys. Always going to be about probabilities. But if you trade probabilities over and over again and your probability is positive, you will make a profit over a period of trades. Not a single trade, but over a period of trades, you will make a consistent profit. I can back 3 horses that all have an incredibly high probability of success and win none of them. But if I just stick to my plan, I'm going to come out ahead. I'm going to come out ahead. It's the same as guys that back 10 to 1 horses that are currently being odds of 20 to 1. They'll still only win 1 in every 10 races. But they're getting paid 20 times. They're getting paid twice the value that they're getting traded. So, but they'll still only win 1 in 10 races, guys. So there's still going to be 9 out of 10 races that they're going to lose, which inside of a probability distribution doesn't sound like a big profit, but is in fact a huge profit. Trying to understand probabilities isn't necessarily probabilities against gains, and probability distributions isn't necessarily about the fact that the next trade you take is going to be a winner. It's purely about making sure that you do play the big games number. You may have 2 or 3 trades in a row that don't work, but if your probability is good and your distribution is good and your confidence is good, you will not have any confidence issues about taking the 3rd trade and the 4th trade and the 5th trade, because you know your probability is sound. When your model's not sound, then of course you've got problems, because you're going to have to fix your model. You're going to have to fix the reason why it's not sound. So building probabilities is what trading is all about, and you can see a great example of that with bonds. This has been a sensational call from the room. We tweeted it, we called it, we talked about it, we tried to get you guys involved, and it's been the best trade of the whole afternoon session by a mile. Brilliant trade, isn't it? Absolutely spot on. And like Gene says, there's got to be a reason to execute. A value line changing isn't a reason to execute. That's just a value line changing. That's a reason to be thinking about executing, right? Because otherwise you'd be in as soon as a paddle flips. But when a paddle flips, it's a call to do something. It's a call to pay attention. You can't be focused. This is why when I ask a question after a buy trade's in, I'm startled at times when I get 0 responses and everybody's in trades, and you're like, you might be in a trade, guys, but there's nothing to do here. What the hell are you focused so much on your charts for at this stage? You can't stay focused for that period of time. It's not good for your health. Your cortisol will be through the roof if you try and stay focused for that period of time without looking away and without blinking. You need to get away after the deal's done. You need to get a step back after the trade is on. Give yourself the chance to breathe. Listen to the classroom. Listen to the classroom answer a question or two. Keep a secondary little glance across at your charts. You don't need to stare back at the charts every 2 seconds to see if your trade is still in. If the value is good, the trade will be good, guys. You let it go. You let it develop. You let it develop, just the way we said on the bonds earlier. Do not over-exit this trade. That's what I didn't say that, but I said let it run. This is a parallel steepener coming into the markets. Let it run. That's exactly what I said, kind of. I says, do not fade this. Don't even try and fade this bond. And sure enough, we've just gone for $2,000 per contract on a short bond without fading it, guys. Anyway, we're 10 minutes ahead of Classroom. Have we got anything that we need to cover in Classroom? Is there any things that have been left unturned? We're going to be covering MZ Pack, and I said that we would cover this in a different Classroom, but obviously that's the only reason I'm covering MZ Pack is we can do a quick recap of some of the tools that order flow allows you to look at in terms of things like the high caught, the low caught, those types of tools. Just so that when you're looking at, if you're looking at Sierra charts or you don't have MZ Pack, but you're looking at the footprint, it's just some of those elements that you want to try and pay attention to in terms of your order flow to make reasonably good, solid trading decisions about transitions taking place. It's perfect for the Monday Club, which is why I'm not going to spend a lot of time on it this afternoon. This afternoon, we'll do a quick recap of why that bond trade was so good. We will again look at the perfect structure on oil, of course, because it was, again, the perfect structure. We'll touch on the gammas on XOM, because obviously it has came to its conclusion today, so that you understand the idea of gamma trading. And obviously at that stage, we will we'll finish off unless there's any other specifics that you guys need to consider. If you've got any questions, guys, fire it into the room. If I missed the question, Kim will gladly ask on your behalf.